If you have an ear to the financial world, and if you have been paying attention to the stock market over the past year and a half, you've certainly noticed a big upwards move in both the Dow and the S&P 500. This upward move is what is known as a bull market, defined as when the stock market rises by at least 20% from its most recent low point. While the positive impact a bull market can have on your investment portfolio is undeniable, is there reason for concern, and how can you make sure you get the most from a bull market when one occurs? Hi, I'm Joseph Eschleman, president of Towerpoint Wealth, a leading independent wealth management firm located in Sacramento, who is a legal fiduciary to our clients. As I mentioned, a bull market officially begins when stock prices rise at least 20% off of the most recent market bottom. And while the official math is easy, it's still tricky to tell when we're in a bull market because it can take time, weeks, months, or even years for the market to rally by 20%. So aside from accurately predicting them, which is next to impossible to consistently do, let's count down the 5 most important things you need to know about bull markets. Number 5, it is important to note that the stock market and the economy are not perfectly correlated. This is an important distinction because the stock market can and oftentimes does rise even if the economy is sluggish. This is because the stock market often reflects investors' expectations of future company earnings and the prospect for increases in stock values much more than it does current state of the economy and of profits. Additionally, the stock market is influenced by a multitude of factors beyond just economic fundamentals, such as investor sentiment, geopolitical events, and even government monetary policy. So while we believe that it is fair to suggest that the stock market does provide insights into these economic trends, it by no means is a perfect mirror of current economic health due to its complexity and the multitude of variables at play. An example, the Dow was at a market low of 64.69 on March 9th, 2009 during the depths of the great financial crisis. It then immediately reversed course and rebounded more than 20% only 3 weeks later. All of this while we were firmly entrenched in a huge recession. 4. Bull markets, like their counterpart bear markets, are a normal part of the investment and market cycle. A common measure of the stock market, the S&P 500 index, has experienced 27 bull markets since 1928. The longest ran for 12 years, from 1987 through 2000, and rose 582%. I bet many investors said the market was too high throughout the many years of this major advance. For additional historical context, according to the Hartford Funds, bull markets last on average 2.7 years and have gained an average of 115%. Conversely, bear or declining markets tend to last less than a year, and on average, they've declined 35%.
Are you a busy investor always on the go? Take the powerful knowledge of Towerpoint Wealth with you wherever you are with our original podcast, A Wealth of Knowledge. Now available on all major streaming platforms, and best of all, it's completely free to download and listen. Now that's an investment worth making. Click the link above and start listening today.
3. If you wait for the right time to invest, you very well might miss many of a bull market's strongest days, which tend to happen early when a bull market begins. Historically, the first half of a bull market outperforms the second half 74% of the time. And even more compelling, the market has risen more than 25% in the first 3 months of a new bull market. The tricky thing about bull markets, We often don't know we're in one until after the fact. 2, even after having said number 3, don't attempt to time the market because nobody can accurately predict when they will happen and when they will begin. Bull markets, including the one we are currently in, set new records and all-time highs often. You simply have to expect and tolerate the inherent market ups and downs that lead up to them. Finally, the number one important thing investors need to know about bull markets and how to take advantage of them: don't let a rising market psych you out. Bull markets lead to new market highs, which may make you wonder when the other shoe might drop. The stock market, as defined by the S&P 500, was too high at 20 in 1950, at almost 104 in 1968, at 211 in 1985, at 417 in 1991, at 1229 in 1998, at almost 2,700 in 2017, and at almost 4,800 last year. The growth of the market certainly does not occur in a linear fashion, which is why you, as a prudent investor, should expect pullbacks and ups and downs, but over time, it has consistently grown and appreciated, especially during a bull market. If you've enjoyed this video, please click the thumbs up button. Please also share it with your friends and family and hit that subscribe button, as Towerpoint Wealth regularly posts timely, relevant, and straightforward educational content on our YouTube page. Thank you for watching.